Hello, everyone, and welcome to Main Street Financial Planning's Swim with Jim. This is Jim Ludwig from Main Street Financial Planning, and we have today our guest for probably the fourth time in about 10 years, Rick Ferri. Rick Ferri is an investment advisor. He's an author of several books. The first one I read that I really became enamored with was all about index funds. He's known for all about asset allocation, the ETF book, a number of things to help individual investors. Good morning, Rick.
Good morning, Jim.
We're glad to have you here today. And our topic is fixed income in today's marketplace. And I'd like to get right to some questions for you. We have a lot of retired clients now that are nervous. How can retirees generate more income without having to experience a dramatic drop in their bond funds? How can they do that?
Well, Jim, what you're saying is, how do I get more income without taking more risk? And I don't have a good answer for that. So I hope I don't disappoint your clients. But the fact is, if you want to get more income from a fixed income portfolio, your choices are take more risk and hope for the best, or don't take more risk and be happy with the income you're currently getting. I know that's not the answer you're looking for, but that is the reality of the marketplace. And if you're a bond investor, and you want more income from your bond portfolio without depleting your principal or having the risk of your principal temporarily going down, there's no good way of doing it that I know of.
Well, how much money do you need if you wanted to put investments into individual bonds and then maybe hold them to maturity?
So bond funds do that. A lot of the bond index funds that are low-cost funds that are bond funds just ladder bonds within the fund themselves. The benefit of doing that is you have literally thousands of bonds and you don't have to go out and buy individual bonds. But if you're talking about going out and buying a bond ladder yourself, there's advantages and disadvantages to that. The first disadvantage is you have to go out and buy individual bonds yourself. And, most people are not experts in buying bonds. You could do it with certificates of deposit. That would work well. One of the problems with doing a bond ladder is when you first buy into a bond ladder, you're buying a 1-year bond, which has a very low yield, a 2-year bond, which has a low yield, all the way out to, say, 5 years, which has a little bit of a higher yield. So you're buying in at a relatively low yield, and you have to wait until the bonds mature, and then you roll them over. So that doesn't produce for you a higher rate of return. It doesn't produce more income for you because, again, the bond funds themselves, this is all they're doing, and they're taking a very small fee for doing that. But if you wanted to do it, you could do it with CDs for as little as $5,000. You put $1,000 in a 1-year CD, $1,000 in a 2-year CD, $1,000 in a 3-year, $1,000 in a 4-year, $1,000 in a 5-year. So you can do it with very little money with CDs. But if you want to use bonds, individual bonds, which I don't recommend, doing that because of there's a lot of high fees within the bond market, and if you're trying to buy individual bonds from brokers, you're not going to get a higher rate of return because their commissions to buy bonds are too high. So if you were going to do it with an individual bond portfolio, I would say you would have to have about $500,000 in a very trustworthy broker who you could trust is not putting in high commissions. And even if you're doing it online yourself with a discount brokerage firm, they're going to crank in pretty good commissions into those bonds. So a bond fund, in my opinion, is the way to go.
Now you talked about laddered CDs, but one of the other strategies I've recently read about, well, I've read about for a long time, but recently it's come to the forefront again, are closed-end funds that seem to have a higher stated return or current yield. How about something like that for extra income?
Well, you said at the beginning you don't want to have the risk of a large drop in your portfolio. The way that a closed-end bond fund gives you that higher yield is they leverage the fund, which leverages the risk inside the fund. So you might be getting 1.5 times the exposure to the fluctuation of bonds in a closed-end fund. So it really is, yes, you do get higher income because they'll go out and borrow money at, say, 3% and invest it in bonds that are paying 4%. And like a bank, they'll make money on the spread, and you'll get a portion of that money as an investor in a closed-end fund. However, if interest rates move up, you're going to get double whacked. You're going to get hit because of the bonds themselves, and then you're going to get hit because of the leverage. So you're really doing yourself if your fear is losing money or having volatility in your bond fund, then a closed-end fund is not the way to go. Even though it appears, with interest rates being relatively stable, it appears as though, oh, this is just a way of getting higher income. There's just no free lunch on Wall Street. You can't draw blood from a rock. There's no greater return without taking greater risk. All the cliches that you hear. The world is what it is, and closed-end funds are fine if you want to take that leverage risk in there, but I think it runs counter to what your original question to me was.
How can they
I'm
generate?
not giving you any good answers. I'm sorry.
But see, that's what I want our listeners and viewers to understand is we can't run around and find increased income without increasing their risk. In your book on ETFs, and you alluded to it earlier about an index bond fund, how little are they charging to generate that income?
It's a phenomenally minimalistic amount now. Vanguard or one of the other indexers, less than 0.1% per year to run a widely diversified portfolio of bonds, and literally dozens of different options of bond index funds and low-cost bond funds are available, from short-term corporate bond funds to long-term treasury bond funds. I mean, whatever it is that however you want to invest in the bond market, and whatever risks you decide to take, whether it's longevity risk or it's risk from credit risk or a combination of the two, you can find a very low-cost, widely diversified bond index fund or a bond fund that would do that for you. So it's not worth, in my opinion, going out trying to pick bonds anymore. I actually stopped doing that even for my own clients. I would say at least 10 years ago, I stopped doing that.
So you've been a writer of a number of different books. Are you working on any new books at this point?
I am, as a matter of fact. The name of the book I'm working on is called The Education of an Index Investor. And it's a behavioral finance book of how people go from this idea that they're going to get higher returns without taking more risk to accepting the fact that the markets are the markets, and getting a return of the market is actually a good return. And so it's the psychological change that people go through as they have an aha moment and realize what the world is and how it all actually works, and then what they have to do about it and how they should construct a portfolio to fit their needs. It's called The Education of an Index Investor. And when's it coming out?
Yes, that was my next question.
Let's say next year.
Okay.
it's been a work in progress. It's not a long book, but it's probably been the book that I've taken the most time writing, because the other books were technical books. All About Asset Allocation was a technical book. All About Index Funds is a technical book. The ETF book was a technical book. This book is be more of a behavioral book, and it's just requiring a lot more thought, how I want to put the message across. So it's taking me 4 times longer to write it, and it's probably half the number of pages as any of my other books, which are usually around 300 pages. It's been an interesting project. So that's what it is.
Well, a lot of your fans and our viewers and listeners will be looking forward to that book. We've been interviewing today with Rick Ferri, CFA, Chartered Financial Analyst, investment advisor, author, an all-around good guy who helps out hourly fee-only advisors. And we look forward to more interviews with you in the future, Rick. Any last words for our audience?
Any last words for your audience? Well, enjoy life, because it doesn't get any better. You're in Italy, correct? You're asking me to give them last words. You're the one who is in the. Give me some philosophical wisdom from Italy. That
right early in the morning. Okay, that's what I do here. Anyway, folks,
I generally get up.
Go ahead.
I generally get up at 4 in the morning and write from 4 until maybe 6:30. Then I go back to bed, and then I get up and start my day. I find that when I'm writing early in the morning, I just have a clearer head and no distractions, and that's how I ended up writing 6 books and worked full time. Was I got up at 4 in the morning and I wrote for a couple of hours every day for 6 months until I got the book finished. And so I agree with you. That works for me. So that's a good piece of advice.
Well, folks, get up early, manage your own portfolio if you want. If not, we'll help you find some good managers. Folks, appreciate you joining us today with Swim with Jim. This is Jim Ludwig from Main Street Financial Planning. Rick, thank you, and everybody have a great day.